Hello everybody. Today we will be looking at and reading through the first of a couple of articles that I found on machine learning and algorithmic trading and the issues and the difficulties that they have in predicting the markets. Might seem like a bit of a funny one given that we actually use some degree of machine learning and algorithms in our trading, but to be good, you have to understand the weaknesses. And so that's what these two articles are going through, is the weaknesses in this type of trading. So without further ado, we will jump in and have a look at this article. So it's from Bloomberg and it's a couple of years old now, but still very, very valid. So it's called "The Big Problem with Machine Learning Algorithms. The potential for tapping new data sets is enormous, but the track record is mixed." Machine learning has enabled investors to tap huge data sets as social media postings, in a way that no mere human could. Yet, despite the enormous potential of machine learning, its record remains mixed. The Eureka Hedge AI Hedge Fund Index, which tracks the returns of 13 hedge funds that use machine learning, has gained only 7% a year for the past 5 years. And so this is in 2018. And so the previous 5 years were 2013 to 2018, which were quite bullish years. And so even in the hedge funds over those periods, they only got 7% a year return. During those times, the S&P 500 averaged 13%. So effectively, these 13 hedge funds that were being tracked only gained half of the market performance. And if you're going to invest in a hedge fund, you are looking to get a return, or at least a risk a risk less and a return of more than the market. But on average, these funds aren't actually obtaining that. One of the potential pitfalls for machine learning strategies is extremely low signal-to-noise ratio in financial markets. So what is low signal-to-noise ratio? Well, the signal is the pattern, or what it is that we're going to trade. So it's the rule. If this happens, then do this. And the noise is all the other sort of factors in the market. So there's ups and downs occurring in the market. Within all that price action, we're looking for a pattern, and that pattern is the signal. And we know mathematically that those patterns are very rare, and the signals are not common. More common is sort of what's called here the noise. So just random stuff. So there's two trains of thought, that the market can be predicted and then the markets are random. And so the low signal to noise ratio is basically saying there's a lot of randomness in the market and only a little bit of predictability. And so that's what this Marcos Lopez de Pradro, who is in the AQR Capital Management, sounds impressive, as head of machine learning, and wrote a book, Advances in Financial Machine Learning. And this is what he has to say about this. Machine learning algorithms will always identify a pattern, even if there is none. In other words, algorithms can view flukes as patterns and hence likely to identify false strategies. So let's have a think about what that says. So machine learning will always identify a pattern even if there is none. Algorithms can view flukes as patterns and hence likely to identify false strategies. So what machine learning does is go over and over and over and over and over the data millions, billions of times and check for all kinds of different patterns that it can identify, and it's literally a black box. You won't know exactly what it's doing because it's got all its neurons firing in different combinations to identify patterns. And if it goes over these data enough, and it's got enough of these neurons, it basically learns the markets. It learns the markets off by heart. So it knows that on this particular day there was an interest rate announcement, therefore it should go short. So it might decide that on the Tuesday of the 7th month it should go short because this one time the interest rate changed and it made heaps of money. And so that is a non-repeatable event, i.e. what it's called in this article is a fluke. And so it identifies that the 7th day in September made it heaps of money at one point. So therefore it predicts that every 7th day in September is going to make heaps of money. And so then that's created a false strategy. And then DiPedro goes on to say it takes a deep knowledge of the markets to apply machine learning successfully to financial series. Because of the fact that machine learning learns the market so well, it ends up finding a whole heap of these patterns. I gave one example, but machine learning will find it over and over again. It will find big movements, make up a pattern to find that one big movement in them that it sees in the data, and then assume that every time it sees that sort of lead up pattern to it, that it'll occur, when of course we know that that's not going to be the case. So in a way, machine learning is too good at learning the markets. It's not learning to find a pattern, it's learning to memorize the pattern or the market that it's shown. And so it's effectively curve fitting to an astronomically good or bad, depending how you look at it, degree. Another guy, Nigel Curitin, echoes this view. He is part of Quest Partners, a New York-based systematic macro hedge fund that manages $1.7 billion. Says that quants coming out of finance programs and high-tech companies often expect to create optimizations at a much higher level of precision that is warranted for finance. So he's saying quants coming out of finance programs, so straight out of uni, and high-tech companies, so ones that are experts in machine learning, often expect to create optimizations at a higher level of precision than is warranted for finance. Now, interestingly, the next article that we'll look at is about the research into algorithmic trading and how often that is wrong. But what he's pointing out here is that finance and our financial data series of prices are very different beast to try and predict and learn than, say, face recognition or self-driving cars or any of the other sort of problems that machine learning is put to. Because a stop sign in a data recognition sense always looks the same. So it's just learning what a stop sign looks like. And once it knows what a stop sign looks like, it can recognize it each time it sees a stop sign. Whereas in finance, a buy signal is not going to be the same every time. Or in effect, the first time it sees a good buy signal, it's not, and says this is a good trade. If it gets too accurate in what that little bit of market looks like leading up to the buy signal that goes up, if it just takes a picture and then looks for those particular patterns, next time that pattern arrives, it mightn't go up, it might go down, because that pattern really has no effect on what comes after it. It just occurred that one time where it got a good result, so therefore it thinks every time this happens, that will come. And so if they're optimizing their systems to find those really precise patterns that led to this really precise outcome, it's going to fail. And by extension, what he's saying there is we actually need to step back in machine learning and have it be less accurate so that it can find underlying patterns rather than over-optimize to particular situations that it thinks will repeat that won't. So he said they're coming in with a mindset that they're going to conquer the world with big data. In finance, though, the market regime is not static, and markets aren't closed systems like a chess game. So what he means by not static is it changes. And I've often heard it said that trading is like trying to drive a car while looking at your rearview mirror. And so all we've got to judge the future on is the past. But the past, what road you drove on in the past, doesn't have really a huge bearing on what's in front of you. You might have a straight road behind you, but there could be a corner coming up, or you could have just gone around a corner and that goes in your rear vision mirror, but then the road straightens, but behind you is a corner. So trying to predict an unknown future with a known past provides this problem of it's not static. So it's not the same as in the past as in the future. So a chess game, while there's different moves in the future, it's all constrained. So chess is a closed system where you can only do certain things and only certain events can occur each particular turn. Whereas in finance, there is no closed rule of what can happen. So it could stay flat, it could go up, it could go down. There's no sort of predictability in it to a large degree. And so that's the problem that people coming from a traditional machine learning background, they don't appreciate that what has happened in the past in finance won't happen in the future. So the problems that they've worked on are different. They're different styles of problems. So it's almost what they've learnt, what works with machine learning in some problems doesn't apply directly to finance. Consider one risk-on strategy that's worked well in the decades since the financial crisis. So this is the 2015 to 18, buying the dips in equity curves. Everyone's buying the dips, Colin said. There are all these people who have learnt to basically suppress the volatility. If you use machine learning, you can implement dozens of versions of this strategy. The risk, though, is the relentless bull markets that make such strategies work well mightn't occur in the future. Meanwhile, skew, a measure of tail risk, is implying that S&P 500 could fall. And I mean, this was 2018, and we've seen the fall both in COVID and again in the past 6 months. So if those machine learning programs just trained on a bull market, they can buy the dip, buy the dip, buy the dip. Nothing can possibly go wrong. They haven't been taught that sometimes buying the dips is wrong or can lead to a disaster. And so there was a skew index, which tracks out of the money index options, has reached a record high. If you're buying the dips with machine learning, it's easy to congratulate yourselves on using much more complex models and optimization and lose sight of the larger risk. So again, he was saying what I just said before, that it seems like it's working, and then the market sort of continues with the buying of the dips thing, and it keeps going well, but then at some point the dip becomes a crash, and does the machine know how to deal with that? Has it been trained enough? Does it understand a broader understanding of the market? Machine learning isn't new, says Robert Frey. Frey in the late 80s started a hedge fund that absorbed a few years later into Renaissance technology, which we all know is one of the four leaders and the forebears both of algorithmic and machine learning. it became the nucleus of statistical arbitrage strategy in the enormously successful Medallion Fund, which is part of the Renaissance technology. All this stuff about machine learning and AI, friend says, most of those techniques, however, have been around for decades, and we, in fact, use a lot of them at Renaissance. The fundamental process that we're talking about here are a combination of advanced statistics, computationally intensive statistical analysis, and then a neural type branch where you're looking at these models, which are basically classifiers. So he's saying there that they don't just use a neural net system to over-optimize, they use it to classify the systems. So the systems are on one level, the statistical analysis of the market, and machine learning is on a sort of a separate level that manages those statistical analysis, which is different to what the people were saying before with the problem. So he's here is offering a solution where the machine learning is taking place a step back from the actual analysis of the market. So we're not letting the machine learning loose on identifying the intricacies of the market. We're looking at the statistical analysis of the market, and then once the statistical analysis is done, machine learnings look at that statistical analysis and make a decision on things one step removed from the market. After retiring from Renaissance in 2004, Fry started the quantitative finance program at Stony Brook University and did this and this and this. Uses machine learnings to evaluate hedge funds, focusing on modeling, blah, blah, blah. We just heard from him. Stephen Currico is another long-time user of machine learning. Oversees 850 million. Started off managing portfolios in 1994. Studied mathematics. Currico says, trying to tease out relationships and correlations in markets data is a fool's game. No scientist or engineer would ever use correlation analysis for analyzing non-complex system of interrelated variables, he said, because those correlations are often nothing more than statistical coincidence and not true cause and effect relationships. So again, it's saying probably in more particular stocks, but really anything, that if variable A happens, then variable B will do this. And so if you're looking at the relationship between different variables and then different outcomes, if you throw enough computing power at it, it will find, like I've repeatedly said throughout the course of reading, that the relationships, the correlations, so it says that this causes this, is nothing more than statistical coincidences. So it finds that over the course of all the data, that Tuesdays at 10:03, if the bar goes up by 15.3 pips, then you buy, because on 3 different days that particular thing happened. Therefore, every time that happens, it should occur. When really, it's found that rule just through coincidence, that 3 times that happened and 3 times it worked. But there is no true relationship there to be found. So he's just talking about his system there, which doesn't really offer us too much insight. The next guy, Wise, $250 million hedge fund, says there's a general idea out there that AI is all-knowing and it's going to take all our jobs. Yet after developing a strategy that uses neural network and machine learning, he sees it as considerably more mundane. It's really just a tool, and a very specific tool too. So Wise was looking at social media and observed they would likely start talking about stocks and investment in similar ways. So they were looking at sort of the Twitter chatter and stuff. Stock twits is his thing. Blah, 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 to develop it. So he developed an investment strategy around the conversation on Twitter. The firm's neural network is thus trained so that when a tweet or comment got found, a sediment score would be given and the model would build on it. Sediment trading, blah, blah, blah. Blah, blah, blah. The EFT is return on average 21% a year. And so he's saying that he, by looking at the Twitter stocks, has doubled his performance to the S&P. So he's saying that he had success with machine learning through that. If it's still working, I'm not sure, but he's just pointing out that he had some success. And so we go on to some other success stories. Lopez de Perio from the start says a couple of favorites. Traditionally, economic linear regression models have been deployed to find investment factors. There's no reason to believe that those factors must be linear. Hence, it's very likely that new factors will be found in the near future to respond to non-linear effect. That's more statistics than machine learning. Another is portfolio construction. And this is a point that I heard Simmons of the Renaissance talk about. Machine learning algorithms can model complex data structures much better and yield superior performance out of sample. And so they use a variance model of portfolio construction. So judging risk of the assets that they've taken and how those buyings and sellings of big companies like Renaissance will affect the market, and therefore sort of the feedback effect on themselves because they're such big players in the market. And Ernie Chan has gone into a similar thing where machine learning, rather than looking at the market itself, looks at the strategies that trade the market and tries to predict when those strategies will work and when they won't. And then finally, in a bit of jiu-jitsu, given the risk of finding I'm having trouble with this word, risk of finding patterns in the data that aren't there, machine learning can also be used to detect false strategies. Most empirical discoveries in finance are false, particularly when they lack economic intuition. The culprit is backtest overfitting. Machine learning can help determine the probability that an investment strategy is false. So he's saying that it could be used in almost the opposite way. So instead of being an overfit problem from machine learning could actually determine what's overfitted by basically robustness testing. So while machine learning and AI are becoming more and more ubiquitous, investing is still a challenging area to apply such techniques. Lopez de Perio just said that beating the collective wisdom of crowds is much more difficult than recognizing faces or driving cars. And to finish off, we've got this amusing quote. My dog can recognize faces, he says. My teenage daughter speaks 3 languages, but I wouldn't trust either of them to my savings. So that's a good article about the challenge of machine learning. Basically, it can be summarized down to finance markets have a low signal to noise ratio. So the actual patterns are very rare and the amount of noise in the data is very high. Now, because of that, if you give very powerful machine learning systems the ability to go over and over this data and learn the intricacies of it, it will find patterns that don't exist. It will think statistical anomalies and coincidences are actual repeatable movements in the market, which they're not. And there's been a real difficulty in the people that develop these to actually achieve success. The statistics are that they only returned half of what the actual market returned. So I hope that offered you some insight into why machine learning is not this silver bullet of solving the financial trading problem, and that in one way it sort of compounds the problem of overfitting to a degree that's far more that we've even seen in the past with the old sort of ways of making systems, just because of the fact that it is literally so good at learning data. And so why machine learning can do amazing things with handwriting and language models and closed games like chess and Go, once it becomes an unknown future with a high noise ratio, it really struggles to be implemented correctly. So hopefully you enjoyed reading through that article with me. And tomorrow we'll go through another one about how the education system and research often lead to inaccurate and wrong conclusions about algorithmic trading. So until you get to watch that video, I hope you all have green pips. And if you'd like to check out more of our research, you can go to TipToeHippo. We named the company really well. And download our white paper, which is all about robust testing to make sure that your algorithmic systems are not curve fitted. So until next time, green pips. Bye.